I think it goes without saying I had to talk about Canopy growth, right? Down 20% today. I did issue a bit of a warning on this stock that I thought it would go down after earnings, and I don't know if I projected 20%. Son of a gun. I was talking more 5%, something like that, but son of a gun, this thing shot down. Let's look at these earnings and see why it decreased so much. Well, it's quarter four EPS of negative 372 Canadian. That equates to, I believe, somewhere around 270 USD. So negative $2.70 USD EPS may not be comparable to the consensus of 44 cents. Negative. That's rough. I know they say that, but I think that's a awful miss. I think that's a horrific, historic miss. And revenue of 107.91 million Canadian, which was up, which by the way is equivalent to around 80 million USD, up 14.7% year over year. Only up 14.7% year over year. Seems small. Missed by 21 million Canadian. Son of a gun. So they missed big on both aspects. Big. These are big misses. When you report a loss of that amount, and we'll look at how much that loss is, because it'll make you, it makes me cringe. But when you report losses that big, you at least want to see a very big revenue growth, right? You want to see a good positive sign from the revenue. It just isn't there. Growth of only 15% year over year is honestly minor for a company that should be growing really massively. And other of these types of companies, as I should say, the Mary Jane companies are growing at higher rates than this. Recreational revenue was down 36%. Are you kidding me? Recreational revenue was down. That is seemingly insane. But you think that's a number that actually should be rising more than really the medical portion of it. Net loss of 1.3 billion Canadian, which equates to around $1 billion USD. Are you kidding? $1 billion USD that they lost this quarter? Down 243% year over year. Of course it was. That is horrible. $1 billion in a quarter. I mean, at least when Uber loses $3 billion in a quarter, they're at least putting up revenue in the billions. Son of a gun. They're not putting up 80 million in revenue. Oh my gosh. I can't even see how that's feasible to lose literally 10 times the amount that you brought in revenue as a whole. You lost 10 times that amount. Son of a gun. This might be, that's, oh gosh. And I don't want to be biased here, but that is ugly. That is horrible. And if you don't see that that is a absolutely horrific number, I think you're smoking a little bit too much of the reefer, right? You're smoking a little bit too much of their product if you don't see that those numbers are literally horrible. I mean, is this a real company? Oh gosh. It's hard to think about it, but maybe it is. So, in connection with organizational and strategic review, CGC recorded impairment and restructuring charges of $743 million. Boom, and the majority of which are non-cash charges. I think there is our really nail. Kind of. I mean, if you think about it, obviously you still have the equivalent of $600 million that is not accounted for in this charge. But still, that's a good portion of it. It's still just, I don't think it's shocking why it's down, right? I think you can completely understand why this thing is down 20% because of it. I mean, that's horrible results. We'll give it a chance though and look at this. So they obviously, this was the end of their full fiscal year 2020. So we'll look at that as well. So for the year, their revenue was actually up 76% as a whole, $399 million in revenue for the full year. So that is good growth there, right? 79% or 76% year over year is good. It's very good. Why was this quarter taking such a big hit? Again, you can talk about pandemic quarter, but these are the businesses that actually stayed open. These recreational and even medical ones as far as this substance. There were companies that stayed open because they were considered quote-unquote essential. Now, I don't necessarily agree. As far as the medical aspect, sure, but recreational, I don't know about that one. Don't know if those should have been the ones staying open, but that is definitely some ugly numbers. Gross margin of negative 85% in quarter four, and that's excluding restructuring and other charges. Oh my gosh. Or sorry, if you exclude the charges, I don't want to be rude here. I don't want to misjudge them. They had a adjusted gross margin of 42%, and when they say adjusted, I don't trust it at all. Net loss of $1.3 billion Canadian. That's ugly. That's for the full year, though, as well. That's one thing I want to mention. This is a full year result. So for the full year, they actually only lost $1.3 billion. And for this quarter, they lost $1.3 billion. So if you think about it, this quarter was just obviously the worst of the worst. So you don't necessarily see an awful trend here. And if you want to think on a positive note, it's not like it was every quarter was bad. It was just this quarter was beyond bad, right? So, as far as this is concerned, Canopy Growth's overall strategy is to unleash the full potential of the devil's lettuce, capture sizable market share in focus categories and markets, and execute a path to profitability. I'm going to say that's going to be a far way off, guy. You might be intaking a little bit of the smoking a little peace pipe, a little too much. That matches products and consumer preferences in the space of the Mary Jane. To achieve this, they will focus on becoming a relentless consumer-centric organization by building world-class consumer insights and analytics. That's right. This is a company, and I'm not even joking, that legitimately will tailor and find a specific strain for you that they think is best as far as your smoking preferences. Personal comments aside, I think it is obviously stupid. Not only is it a big waste of time, money, and a lot of these companies do offer that actually, but I put my personal comments in there just because I think it is a little bit ridiculous. But I don't know. I get they want to build a consumer base. That's really their goal. But in the process of that, they're going to be creating so much expense that this is a company that's going to need funding like no one's business. Marketing and product categories with the highest and most tangible profit opportunities in the near term. They want to try to increase profit. Debatable. Canopy Growth expects fiscal year 2021 to be a transition year for the company and resets its strategic focus, rolls out a new organizational design, and implements comprehensive operational and supply chain productivity program. Given this, as well as significant uncertainties, the company is withdrawing guidance. What a shocker. Guidance, and really it's milestones for them, so pretty much them saying by this time point, we're going to reach this amount in sales or this amount of profit. Well, for them, profit obviously doesn't exist, but you see quarter over quarter a 13% decline in revenue. Not the end of the world. Net loss, so a 1,110% decrease. Oh gosh. Quarter over quarter, and a 282% increase year over year. Oh gosh. Oh boy, do I hate to see it. So honestly, they'll give some of these highlights, and I don't know if there's many highlights. Business highlights, there's here the ready-to-drink beverages under Tweed and Houseplant brands represent a total of 3 SKUs. They're available at in the Canadian recreational market. Pretty cool for them. Canopy has expanded offering of hemp-derived CBD products with the launch of the first and free topical creams in select states in the United States, and the launch of the Works line in clinically proven CBD booster skin products in the UK, Germany, and select states in the US. On May 1st, an indirectly wholly owned subsidiary of Constellation Brands, which is obviously one of the biggest alcohol companies out there, if you don't know them, exercised warrants for approximately 245 million Canadian dollars, representing approximately 5.1% of issued and outstanding common shares. I feel like it just got dark out of nowhere. I don't know what's happening. It's very weird outside. But let us look here at, give me these results. Give me these results, baby. You're not going to hide them from me, are you? You're not going to hide them from me, are you? Oh, they're not. Let's look at this balance sheet. And it is in Canadian dollars. So just recall, Canadian dollars, I think 73 cents to the US dollar. Every Canadian dollar is worth 73 cents for US dollar. So we will do the math based off that. If you're looking from a cash and cash equivalent standpoint, son of a gun, that is an ugly number, obviously. 1.3 billion Canadian, around 1 billion USD, versus 2.4 billion Canadian last year. I do like that they give me a year-over-year comparison. Good for this company, give me a year-over-year comparison, which is equivalent to right around the $2.1 billion mark. So half in terms, really right around half in terms of the current cash and cash equivalents for them. Total assets in general, you're seeing a number of 6.8 billion Canadian versus 8.5 billion a year ago. You don't like to see a decline in assets like that. You really don't. But again, that's all loss attributed to really this company or the operations of the year. You'd also hope to see a liabilities decrease ideally. So we'll see if that's the case. Don't know if it will be, but total liabilities on this company actually increased 1.4 billion USD Canadian versus 1.67 Canadian this year. They do actually have more assets than they have in terms of liabilities, I will say that. But at their burn rate of cash, I don't like what's going on. If we see any more really quarters like this quarter, this company is going to be in some hot water pretty quickly. Now, I don't think every quarter is going to be like this quarter. My question, though, is where the value comes in with these shares, right? How do you value this company? There's not really a metric to value any of the stocks in this field right now, just because they're all growing revenue at similar rates. They're all burning cash at extreme rates, and the valuation is expensive on all of them. I mean, these are stocks that were obviously hype stocks that shot up to extreme levels and have really since then fallen quite a bit, 60% from their highs, even more than that, and now even a bigger drop today. It's where's the valuation on these? I personally am not going to invest in any of these companies just due to the fact that I don't see where the valuation is going to come on. It's way too much volatility for me, and if the volatility is your game, I'm happy for you, right? I think the best way to make money in these type of companies, again, is going to be option plays based off of earnings. That's kind of how it is. So if you bought put options for this company, I congratulate you, right? I was very well tempted to, and I mentioned that that I did think this thing was going to go down, but I don't think I'm going to potentially even think about purchasing any of the companies in this field right now. And again, it could be me missing out, but I do think there are a lot better buys in the market right now, which have actual appropriate valuations. Now, if you're interested in the stock, definitely do your own research, and I'm certainly not telling you not to invest. Do whatever you feel is possible, all right? Thanks, buddy.